Welcome to another tutorial for A-Level Accounting. My name is Farhan, and in today's lesson, you will solve questions 1 to 12 from May 2023 Paper 1 exam. You'll also find a separate video where I'll be solving questions 13 to 15. You'll find similar practice questions that I upload on a daily basis, so make sure to subscribe to this channel. With that being said, let's get started. So in question 1, which stakeholder will not find the schedule of non-current assets useful? Starting with the first option for debenture holders. Debenture holders are also known as the debt holders of the company. These people have lent money to the business so that in return they could get paid an interest on it. Now, the debt holders will obviously lend money to the company based on how financially solvent a company is. And one best way to determine that is to look at the total amount of non-current assets that a business has at a given point in time. Starting with the second option for existing shareholders. Existing shareholders refer to investments that have already been made by people. In other words, these people have owned equity interest in the company. Therefore, these people will obviously find the schedule of non-current assets useful because it shows how their money, that which they have invested in the past, is being utilized within the business in terms of growth and running operations. The third option for local community. Local community has no financial ties to the company. Therefore, they really won't find the schedule of non-current assets useful. You could think of the local community as a consumer who has no investment in the business, but rather they consume the products that the business is going to produce. So this group of people won't really find the total amount of non-current assets of any use in having to decide whether they're going to consume or buy a product. Therefore, the correct option to select in this case would be option number C. As you can see, I've circled here. Let's look into the last option, potential investors. The potential investors, let's say they have a large sum of money, and to make their decision whether or not they want to invest in a typical company, they would want to look into the non-current assets that the company has. The larger the non-current assets, the more the assurance that their money is going to be in good hands. Therefore, the potential investors will definitely find the schedule of non-current assets useful. So out of the 4 options, the best option to select in this case would be the local community, which is option number C for question number 1. Let's move on to the second question. Which of the following is an example of an error of principle? Starting with the first option, an invoice for machinery repairs posted to the machinery cost account. So machinery repairs is an expense, and machinery cost account relates to the cost for a non-current asset. So what's happening in this transaction is that we have treated an expense wrongly as a non-current asset. So expense is a different class compared to non-current asset. So when we record a transaction in a different class, that is what we refer to as an error of principle, which is what you can see in this case where the expense has been wrongly treated as a non-current asset. And due to these variations in classes, which do not really go by with the transaction, therefore we call this an error of principle. The second option, an invoice for machinery repairs posted to the rent and rates account. Now, machinery repairs is an expense, as we have already understood in the previous point. Rent and rates is also an expense for the business. So what happened is that we wrongly classified an expense by showcasing that expense when recording the transaction in a different expense account. So the class is the same for both rent and rates and machinery repairs, which is expense. But what we have done wrong here is that we have recorded the expense in the wrong expense account. So when we record a transaction in a wrong account that falls within the same category or in the same class, and in this case, which is an expense, that is what we refer to as an error of commission. As you can see, I have highlighted here. Option number C, a sales invoice not recorded in the sales journal. So this is pretty straightforward. Not recorded simply means that this has been omitted from the books, and therefore this is what we classify as an error of omission. Option number D, a sales invoice posted to the debit of the sales account and credit of the bank account. So The correct way to record option number D would have been to debit the bank and credit the sales, because sales by default is credit. And when we make a sale for cash, your assets in the form of bank increases, and any assets when they increase would need to be debited. So this would have been the correct way to record this transaction. But what really happened in this case is we have done the exact opposite, which is to debit the sales account and credit the bank account. And this type of error is what we refer to as an error of complete reversal. So the correct option to select for question number 2 would be option number A, which is an error of principle. And option number B is what we have justified as an error of commission. Option number C is what we have justified as an error of omission. And option number D is what we have classified as an error of complete reversal. So let's move on to question number 3 now. Which item would be included on the debit side of the purchase ledger control account? Now, first thing first, what's the purpose of preparing a purchase ledger control account? The purchase ledger control account calculates the total amount at a given point in time that a business owes to its credit suppliers. In other words, the purchase ledger control account calculates the current liability or credit payables or credit suppliers that a business has. So the purchase ledger control account represents a liability account by default, which means the opening balance of the purchase ledger control account would be on the credit side, and any credit purchases that we make from our suppliers would also be reflected on the credit side of the T account that we prepare. That means anything that goes on the debit side of the purchase ledger control account must refer to a reduction in the amount that the business owes to the credit suppliers. So this is the type of thing that we need to look for in each of the options, which justifies a reduction in the amount that a business owes to its credit suppliers. So let's start with option number A. So in option number A, you see we have been provided with discount allowed, which in no way is relevant to a purchase ledger control account. Discount allowed is something that we as the business give to our credit customers. So discount allowed in no way is relevant to a purchase ledger control account, and on that basis I can easily cancel out option number A. Starting with option number B, so we have discount received. So if we receive a discount from our credit supplier, that reduces the obligation that we have towards a credit supplier. So as we have justified earlier, so any increase of credit purchases would be reflected on the credit side of the purchase ledger control account, but any reduction would be reflected on the debit side. So when we receive a discount from our credit suppliers, that reflects a reduction and therefore should be recorded on the debit side. Okay. What about purchase returns? It's the same thing. Let's just say we make purchases on credit in the past from our credit suppliers, which is obviously going to be recorded on the credit side in the past. But now that we have made a return to our supplier, that's going to result in a reduction in the amount that the business owes to its credit supplier and therefore needs to be recorded on the debit side. Okay, what about a contra entry? So contra entry in this case refers to a reduction. And how can we justify the meaning of contra entry here? Let's just say the same supplier from whom we have purchased on credit is the supplier to whom we have also sold something on credit. So on that basis, we can offset the balance that we have sold to our supplier on credit with the balance that we have purchased from the supplier on credit in the past. So this is what we call a contra entry, where we can offset different transactions based on the purchases and sales that we make to a specific customer, a specific supplier. Therefore, contra entry, which has to relate with the sales that we could possibly make to our credit supplier, would now result in a reduction in the amount that we owe to our credit supplier. And therefore, on that basis, the correct option to select would be option number B. So as you can see, we have circled here. So option number B is the correct option to select. Let's go through the other two options as well. Option C, we have discount allowed to begin with, and it's a straight red flag. Therefore, you can cancel option C straight away because discount allowed is what goes to a sales ledger control account and not a purchase ledger control account. Discount allowed, again, is what we as the business give to our credit customers for prompt payment. So discount allowed has no relevance to the credit supply account in this case, which is the purchase ledger control account. Let's move to option number D. So in option number D, we have discount received and purchase returns, which would have checked our boxes. But what about interest charged? So interest charge should actually increase the liability. And when do our credit suppliers charge us interest? When we fail to make a payment on time, which would mean that the total obligation that we have to our credit suppliers will eventually go up. And therefore, that results in an increase in our liability. And any increase in liability must be recorded in the credit side of the purchase ledger control account. Therefore, this does not reflect a reduction, and therefore option D cannot be valid in this case, and thus the correct option to select for question number 3 would be option number B. All right, so which of the following is an example of capital income? Capital income refers to income that arises from the sale or investment of assets. In other words, this income doesn't come from the regular operations of the business. Starting with the first option for commission received. Now, commission received is typically earned from providing services or facilitating sales and transactions, which is considered operational or revenue income rather than capital income. The second option for credit note received for cancellation of maintenance contract. This is more like a correction or adjustment that relates to regular business operations. There is no investment or sale of an asset. This, therefore, has to be involved in income or expenses, but it doesn't constitute the definition of a capital income, which has to do with selling or investing in a non-current asset. Credit sales simply means sales made on credit. Here we have no non-current assets involved. This is part of the regular operations of the business. Therefore, option C is also not going to be valid. What about option D? Trade in value of machinery used in part exchange. What's happening here is that machinery is a capital asset because it's a non-current asset, and we are using it as part of an exchange deal, and the value that we receive in this transaction is what we call a capital income. This is because this income is received by disposing the fixed asset, which is distinct from the regular operations of the business. Therefore, the correct option to select for question number 4 would be option D, which is trade in value of machinery used in part exchange. Question number 5. Which is the correct formula for the calculation of interest coverage? Interest coverage stands for the ability to pay interest expense with operating on earnings. And the higher the interest coverage for a business, the less is the risk of defaulting on the loans. In other words, there is less risk for the business to not be able to pay its loans. Now, you will find the formula given on page 33 of the syllabus. And it's very straightforward, which in this case, we can select option number D, which is profit before interest and tax divided by interest payable. Now, profit before interest and tax is also known as operating income. Again, the definition of interest coverage simply means the ability to pay interest expense with operating earnings. And the higher the interest coverage, the better or financially solvent a business is, which in turn also reflects the less likelihood of defaulting on any loans that the business has. So the correct option we would select for question number 5 is option number D. Let's go to question number 6. Which book of prime entry will be used to record a check received from a previously written off irrecoverable debt? So irrecoverable debt, in other words, relates to the bad debts or the debts that we perhaps would not be able to collect from our credit customers to whom we have sold goods in the past on credit, and now they're unlikely to pay. So this debt was already written off in the past. And now what's happening is that the customer who wasn't able to pay us in the past is now able to pay it back. As you can see, we have received a check from a previously written off irrecoverable debt. So let's look into each of the options and see what's happening. Starting with cash book. What's the purpose of a cash book? Cash book records any transactions of the business that has to do with cash inflow or cash outflow. When we are receiving the check from the customer for our previously written off irrecoverable or bad debt, This check refers to cash inflow, which is money coming into the business. And therefore, the first place where this should be recorded, or the book of prime entry where this should be recorded, is the cash book. So the correct option to select in this case would be option A. What about general journal? So in general journal, we record unique entries that do not require specialized journals like sales journal or purchases journal. And general journal also records adjusting entries, accruals, and any corrections of errors. So this is the main types of transactions that gets included in the general journal. Sales journal records credit sales, pretty straightforward, which is a specialized journal, as we have just discussed in general journal, which do not show any specialized journal transactions. And sales returns journals is very simple. It refers to any returns in sales that we have made in the past that's done by our customers to the business. So the correct option to select in this case would be option A, which is the cash book that records transactions, anything relevant to cash inflow and cash outflow. And because we have received the check, which refers to a cash inflow, this needs to be first recorded in the cash book as the book of prime entries. So let's move on to question number 7. A sole trader has prepared our income statement for the year ended 31 March 2023, which showed a profit for the year of 35,360. However, it was discovered that the interest received of £2,250 have been debited to the interest paid account. What is the corrected profit for the year? So first of all, we need to fix this mistake that was made. So interest received of 2,250 would refer to interest income, and any income by default has to be credited. So what we have done is first recorded the credit which relates to the interest income of 2,250. In other words, the business has an extra income coming from interest of 2,250. Now, there's one more thing to fix. We know that this was debited to the interest paid account, which relates to an expense account. Now, we also need to get rid of this expense effect that we have done earlier. So if we had treated this thing as an expense, we would have debited it when we would have recorded this transaction. But now that we have to fix it, we have to offset that debit which we have originally made, and therefore we would be crediting interest expense by 2,250. So we have two credit entries, one for interest expense 2,250, which reflects an increase in interest income, and one for interest expense of 2,250, which refers to a reduction in the expense that we have originally recorded. So the debit in this case is what we call a suspense account to come in and fill the gap. And the suspense account will be the total of everything on the credit side, which is 4,500. So this is the correct way to fix this transaction if you get any question like this in the exam. Now, what is the corrected profit for the year? To begin with, we start with the profit that we have been given, which is 35,360. And you see we are adding back 2,250. Why are we adding 2,250? Because when we are crediting interest income, our income is going up, which means, in other words, the profit should go up, and therefore this can only be reflected with a plus. At the same time, we are again adding another 2,250, and where is that coming from? You see, we have credited interest expense. So when we credit interest expense, we're actually reflecting a reduction in the expenses of the business. If we reflect a reduction in the expenses of the business, that is going to increase the profits of the business, and therefore we are adding 2,250 for this reduction as well. So the final answer is 39,860, which is what you can see we have selected for option number D. Okay. So let's move on to question number 8. Marge has provided the following information for the year ended 31 January 2023. What is the value of the credit sales for the year ended 31 January 2023? Now, the best way to solve this question is to prepare a ledger account, or a T account, which is the sales ledger control account. So the sales ledger control account calculates the total amount that the credit customers of the business owes to the business. So we start with the opening balance, which is going to be on the debit side. And this opening balance is from trade receivables at 1 Feb 2022, which is 6,330. Now, why is the opening balance on the debit side? Now, sales ledger control account refers to the trade receivables or the credit customers of the business. Now, these trade receivables or credit customers of the business are assets of the business because they owe the business money. So any assets by default must have an opening balance on the debit side. So that's why we have an opening balance on the debit side of the T account, which is 6,330. We have been also given the closing balance at 31 January 2023, which is 6,870. Logically, if your opening balance within the sales ledger control account is on the debit side, the closing balance must be on the credit side. So, which is what we have done in this case, 6,870. Now, dishonor check of 145. So, dishonor check refers to a check that a customer may have given to you, but it actually failed to be processed, which in return would be actually increasing the amount that this customer owes you. And therefore, that needs to be going on the debit side, because if this goes on the debit side, it shows that this trade receivable owes you money, owes the business money. So we are supposed to calculate this value for sales. So let me just highlight this. We're coming back to this. So let's move on to the credit side, where we have bank of 58,100. This means the amount that we have received from our credit from our credit customers or trade receivables, which is what we have got from here, receipts from trade receivables. And if our credit customers have already paid us, that should reflect a reduction in the amount that they owe us, and therefore it's shown on the credit side. Now, how do we come up with this figure? So what we first did is to add up everything on the credit side, and we got a total of 64,970, which must be the total on the debit side as well. And we subtracted the balances for opening balance and dishonor check, and we got this remaining value of 58,495, which has to be the credit sales that the business has made during the year. And therefore, on that basis, the correct option to select would be option number C. You'll also find similar practice questions or many multiple choice questions that I've uploaded. So make sure to check that video if you want extra practice as well. So let's go to question number 9. The motor vehicles provision for depreciation account for the year ended 31 December 2022 contains the entries. So as you can see, we are given the opening balance on 1 Jan 2022, and we are given the closing balance at 31 December 2022. We are also given the depreciation charge for the year, which is the depreciation expense that is shown in the income statement. On 31 October 2022, a motor vehicle was sold. There were no other additions or disposals of motor vehicles during the year. What entry will be made in the motor vehicles provision for depreciation account to record the depreciation on the motor vehicles sold? All right, so I've prepared a T account or a ledger account for a provision for depreciation. So provision for depreciation should always have an opening balance on the credit side of the T account, which is 40,512, which is coming from here. And therefore, the closing balance needs to be on the opposite side, which in this case is the debit side. And as you can see, we have included that here, which is £22,293. Now, during the year, we have depreciation expense of 7,922, which is what we will be showing in our income statement. But also at the same time, it increases the total provision for depreciation that the business has. So if it increases the total provision for depreciation, we have to record it on the credit side to reflect that increase here. And the P&L here stands for the profit and loss of the income statement of 7,922. What I'm trying to say here is that this 7,922 is the exact expense for depreciation for the relevant year, and this is disclosed in the income statement or the profit and loss statement. Okay, so the question wants to know what entry will be made in this account to record the depreciation on the motor vehicle that has been sold. So this balance to begin with wasn't given there, so we had to derive it ourselves. So what we did was first calculate the total of everything on the credit side, which was the heaviest side, and we got 48,434. That also needs to be the total on the debit side. From that balance, we subtracted the closing balance that we had, and whatever we are left with, 26,141, relates to disposal. Basically, everything on the debit side of the provision for depreciation account reflects the disposal of the non-current asset, the specific depreciation for the non-current asset that we have disposed. So in other words, the assets that we have sold had a total depreciation of 26,141, which you can see is included on the debit side of the T account, and therefore the correct option to select for option D would be option D, which is 26,141 debit. So let's move to question number 10. The following information is available for the year ended 31 January 2023. Provision for doubtful debts account at 1 Feb 2022, which is the opening balance of 5,942 that we are given. We also know the closing balance for trade receivables, which is at 31 January 2023 of £148,700. A provision for doubtful debts of 3% is required at the end of year. What is the income statement entry for doubtful debts for the year ended 31 January 2023? First of all, we want to calculate the provision for doubtful debts at the end of the year using the 3% that we have been given, which we will be multiplying on the trade receivables that we are given at the end of the year, which is £148,700. So once we do that, we get a provision for doubtful debts of £4,461 at 31 January 2023. So let me make that note here. It's 31 Jan 2023. Now, what we want to do here is compare this value that we have derived, which is 4,461 for the provision for doubtful debts at 31 Jan 2023, with the beginning balance of provision for doubtful debts of 5,942 at 1 Feb 2022. We can clearly see that the amount has decreased, and the difference in that case, or the reduction, is 1,481. Now, is this a good thing or the bad thing for the business? Now, provision for doubtful debts relates to the possibility of the amount of credit sales that would likely be not collected. Now, at the beginning of the year, we had more risk of not collecting the credit sales. But at the end of the year, this risk has gone down, and this has gone down by £1,481. This is a good thing for the business if the risk has gone down, which means that we need to classify it as an income in this case. And the correct option, therefore, to select would be 1,481 as an other income. Why other income? Because this is income not coming from your regular operations. So this is the main reason for classifying it as an other income. Let's start with question number 11. A bookkeeper received a purchase invoice that has not been recorded in the accounts. Explain why this error might not be discovered. So I've prepared a response here. So mainly because this is 3 marks, you need 3 key points to be able to score full marks. So just go through the response that I have prepared and get an understanding of how you could approach similar questions in your exam. An error of omission occurs when a purchase invoice is missed and not recorded in the financial records. This type of error can go undetected because it doesn't create an imbalance in the trial balance, which only checks for equal debits and credits. Since the transaction was entirely omitted, there is no entry that can disrupt this balance. Consequently, both the purchase ledger control account and the purchase account in the general ledger remain unchanged as if the transaction never happened. This oversight can lead to inaccuracies in financial statements as the expenses and liabilities related to the omitted invoice won't be reported. The error might remain unnoticed since the trade payables and purchase ledger control account will still reconcile, showing lower amounts that incorrectly match up due to the missing invoice. Without specific efforts to find such omissions, the transaction could stay unrecorded, affecting affecting financial accuracy. So mainly your response is within the first paragraph of, of this question that I've prepared. But in the second paragraph, we are trying to show you the effect of what's going to happen if this is not recorded in the books. So the first paragraph explains why this error might not be discovered, and the second paragraph explains the effect of not recording this transaction, which is mainly the inaccuracies in the financial statements. So if in exam you get a question for discussing the effect, you can prepare a similar response to what I've done here and you'll get full marks for sure. So let's start with question number 12. The following information has been extracted from the books of account for Peter for the year ended 31 January 2023. We are given the opening balance of inventory at 1 February 2022, and we are also given the closing balance of inventory at 31 January 2023. We are given the purchases for the year, the returns in words, and the revenue for the year. We are given some extra information. During the year ended 31 January 2023, Peter took goods with a selling price of £2,800 for his own use, which have not been recorded in the books of account. The markup on these goods was 25%. Included in the inventory at 31 January 2023 were 2,000 items with damaged packaging. These items cost £13.50 each and have a selling price of £14.65 each. The total cost of replacing the packaging is £2,850. The requirement for this question is to prepare the trading section of the income statement and calculate the gross profit for the year ended 31 January 2023. So let's do some workings before we prepare this income statement. So starting with the first additional information, we know that there has been some personal drawings made by Peter for inventory of £2,800, and this £2,800 that we are given here relates to the selling price of the inventory. The markup on these goods was 25%. What we have to first do is calculate the cost of this inventory that Peter has withdrawn. So let's do that first. So cost of inventory in this case can be calculated by taking the selling price, which is £2,800, and then dividing it with 1 plus 25%, which gives me £2,240. Now, you might want to understand, how did I arrive in this calculation? So let me show you something. How do we determine the selling price of an inventory? We start with the cost and then we multiply 1 plus the markup, and that gives us the selling price. Okay? Now, in this equation that we have just prepared here, the main thing of interest to us is the cost. So this is something that you can memorize, or logically speaking, when a business tries to make money on the products it sells, it obviously has to do some markup on the cost of the inventory that it pays for to bring those items in the business. And after marking it up, it can sell it for a profit to its customers. That is the whole purpose of existing or having a business in place. So if I was to find the cost here using algebra, the selling price needs to be divided with 1 plus markup. So that is basically what we have done here. So we took the selling price of £2,800 and then divided with 1 plus markup, which gives us the cost of the inventory that Peter has withdrawn of £2,240. So the first additional information has been taken care of. Now let's look into the second additional information. Included in the inventory at 31 January 2023 were 2,000 items with damaged packaging. These items cost £13.50 each and have a selling price of £14.65 each. The total cost of replacing the packaging is £2,850. So what we are going to do first is calculate the cost per item of packaging. So let me show you the calculation. So cost per item of packaging. So we know that to replace the packaging, we need £2,850, and we have 2,000 items in total. So if I want to find the cost per item, what I will have to do is take the total cost of replacing, which is £2,850, and then divide it with 2,000 items that we have as a whole, which gives me pound 1.425 as the cost per item of inventory to replace the packaging. All right. So you can see that for all these inventory items, we are given the cost, which is £13.50 each, and also the selling price of £14.65 each. So what we have to do is first calculate the net realizable value. Now, the net realizable value can be calculated by taking the selling price that we are given and subtracting any additional costs to replace that item for the packaging in this case, which is £1.425. So let's derive that number first. So if I want to find the net realizable value, I take the selling price and then I'll deduct the cost per item of packaging, which in this case is 1.425. So selling price is 14.65 minus 1.425. So that gives me 13.225 pounds as the net realizable value. Now, inventory is valued at lower of cost or net realizable value. This is a universal rule that you must remember always, which is always going to come in handy when you are doing a similar question during your exam. Inventory is valued at lower of cost or net realizable value. So, what is the cost that we are given? £13.50 each, and the net realizable value that we are given in this case is £13.225. So let's find the difference for these two amounts first. And this is the amount by which we have to write down the inventory, because as you can see, the correct value that we need to use for valuing this inventory has to be £13.225, not £13.50, which has been done originally. So what we have to do is reduce the effect of this difference for all these 2,000 items that we have in our financial statements or in the books. So let's calculate the inventory right down here. So first of all, what we have to do is find the difference between the net realizable value and the original cost, which is 13.5 minus 13.225. And then because we have 2,000 items in total, we want to find the total inventory write down, which will be 2,000 multiplied by the difference of 13.5 and 13.225. So once we do that, we get a total of £550 as the total amount that we need to write down for the inventory. So let's do a quick recap of what's happening in point number 2. So point number 2 states that the closing balance of inventory that we have been given here, which is 29,785, has some items with damaged packaging. And to replace those packaging, we need a total of £2,850. The total number of items that needs to be replaced is 2,000. So what we have to first do is calculate the cost per item of packaging, which is simply taking the total cost of £2,850 and then dividing it by 2,000 items, which gives me £1.425. Once that is sorted, then we want to find the net realizable value. The net realizable value is calculated by taking the selling price per unit, which we are given, minus the cost per item of replacing the packaging, which is 1.425 that we have derived in the previous equation. Once we do that, we get a net realizable value of £13.225. Once we have our net realizable value, we need to bring into play the universal law of inventory, which is that inventory needs to be valued at lower of cost or net realizable value. The cost is 13.50 pounds each, which has already been factored into this calculation of closing balance that we're given at the beginning. However, the net realizable value is 13.225 pounds, which is lower than the cost that we have. And that means that we now have to write down our inventory. So first we find the difference by subtracting 13.225 from 13.5. And once we have that, then we multiply it by 2,000 items to get the total inventory write-down value of 550 pounds. All right. So now that we have sorted both this information that we're given, let's prepare the extract for the trading section. So this is going to be pretty straightforward and easy. So we're going to start by creating two columns. And we're going to start with revenue, obviously. So revenue has been given in our question, which is 225,000 pounds. So let's do that. So revenue, 225,000 pounds. From revenue, you subtract return inwards. Now, return inwards, in other words, is also known as the sales returns. So any sales returns is going to reduce the original revenue that you have. Therefore, we have to subtract this in this case. So revenue is given as 225,000 pounds. And from there, we subtract the sales returns or returns inwards of 16,440 pounds. Since we are subtracting this, I'm keeping it within a bracket, and we get a total of 208,560 pounds. Now we bring the cost of goods sold calculation. So how do we derive the cost of goods sold? It's the same equation that you're going to follow everywhere whenever you prepare an income statement. We start with the opening balance of inventory that we're given. Then we will be adding any purchases for the year. And then you will be subtracting any drawings in this case, which we have a personal drawings, as you already know. And then you can subtract your closing inventory. Now let's get all the numbers from the information. So opening balance of inventory is 34,195 pounds. And then we're given the purchases, which is 155,000 pounds. Then we have to subtract the drawings, the personal drawings. And remember, in point number 1, we were given the selling price. And what we did was use this equation to derive the cost of the inventory that Peter has withdrawn, which in this case is 2,240 pounds. Again, you can all memorize this equation because this is the same thing everywhere you go. The way you determine the selling price is take your original cost and then multiply it with 1 plus markup. And if you want to find the cost, then you just simply use algebra. So you divide the selling price with 1 plus markup, which is what we have done here. The selling price was 2,800, and 1 plus markup means divided by 1 plus 25%, and that gave us a cost of inventory of 2,240 pounds. So that is the amount of drawings. So 2,240. So we're going to keep it in brackets to reflect a reduction in this case. So the closing inventory in this case needs some adjustment. So I'm putting a star here to show something here. Now, what was the original value of the closing inventory that we were given in the table prior to making any adjustments? So the original value of the closing inventory was 29,785 pounds. So we take that number, 29,785 pounds, and from there we write down 550 because, as you know, with point number 2, there was this damage with packaging which we had to replace, and therefore the total amount that we have to reduce for inventory is 550 pounds, which must be taken from your closing inventory. Again, you might have a question why we are doing this. Why are we taking it from the closing inventory? Because the question clearly specifies that included in the inventory at 31 January 2023, so which is obviously the closing inventory. So We subtract this £550 from the initial value for closing inventory that we were given, and we get 29,235. That is the value that needs to be going here. Again, as part of the equation for cost of goods sold, closing inventory needs to be subtracted. So this formula is basically opening inventory at purchases minus drawings and then minus closing inventory. So once we do that, we get the cost of goods sold, which is £157,720. Again, this is in bracket because the way this works is that we take our net sales, which is 208,560, and subtract our cost of goods sold from that amount, which is 157,720, and we arrive at our gross profit in this case. So the gross profit that we can derive is 50,840. So that's all for question number 12. Thanks for listening to this video. I believe you found a lot of value in this content. Don't forget to drop a like and subscribe to this channel. You'll also find questions 13, 14, and 15 that I'll be uploading tomorrow. Make sure to subscribe to this channel so that you can get the best preparation for your exam. I'll see you in the next video.